So just in the basics, just straight up, a rehabilitation tax credit itself directly reduces the amount of tax that you owe to the government. This is a great thing because it's a dollar for dollar reduction. Most deductions are, it reduces the amount of apparent income, taxable income that you're then taxed on by the feds and by the state. This actually gives you a direct amount of money back. So if you owed the state or the feds $1 in taxes and you had a tax credit for $1, you would get that money back. And in most cases, you can reduce your tax burden, your annual tax burden, down to either zero or at least the minimum that you're required to pay in any given year. It's based on a percentage of the money that you spend on a project. So we talk about 20% tax credit, 30% tax credit, things like that. That percentage refers to the amount of money that you're going to get back based on what you spend. So if you spend $100,000, and you had a 20% tax credit, that would result in a gain to you of a tax credit of $20,000 that you could then apply towards your annual taxes, your federal income tax and your state income tax. And those tax credits carry forward. So if you don't have a $20,000 tax liability for 1 year, you can chip away, you can use a little bit of your tax credit each time. Let's say you only owe $5,000 in taxes a year. You can draw off of that tax credit each year for 4 years or until the tax credit is completely exhausted. And that idea behind it is that this is a reward for people who do rehabilitation of historic properties. This is not quite restoration because it does allow for changes. So you're not just restoring a property to the way it would have been in, say, 1895. You're restoring the character defining features, the thing that makes the building historic in the first place, but it does allow for you to make changes to the building and upgrades that would put it into the 21st century and make it something that would be usable to either commercial users or residential users in the year 2020. And the good news is that some of those changes that you make to the property would themselves qualify for tax credits. So upgrades and rehab, restoration work, all of those costs would bump up your total tax credit. Again, there are two kinds of tax credits, federal and the state. The federal applies only to commercial properties, only to income producing properties, property that you use to make money and is not your personal residence. The state credit is much broader and it applies to all properties. There is a tax credit for commercial properties that's very similar to the federal, but there's also a special tax credit just for owner-occupied residences that is available on the state level. So how do they define commercial and residential? Commercial, very straightforward. As you see here, most people think commercial, they think of a store, a place where you can open up a shop or a restaurant, coffee place. Hopefully once all of this coronavirus goes away, be able to open pretty much anything. But it also applies to other things. It applies to rental residential properties because that's a building that you own that other people pay you money to live in. It applies to industrial properties. It applies to ranches. It applies to farms. Anything where you are using that property to generate incomes for you. Residential, on the other hand, is defined as a property that you use as your own personal residence. So it's an owner-occupied property. That could be your primary home. It could even be a second home. The important thing is that you're using that for yourself and not to generate income. The work has to meet the Secretary of the Interior standard. This is a big thing because this is actually built into both the federal and the state law because there are a lot of different ways in which you can be reviewed for historic appropriateness or getting a certificate of historic significance. The standards are the ones that are required for the tax credits. These were created about 40 years ago by the National Park Service, who updates and maintains them on a regular basis. There are 10 standards in total, and the idea behind it is to provide a set of guidelines for what is a rehabilitation that protects and preserves historic defining features and characteristics of a property and what is allowable in terms of making changes. Again, the focus here is rehabilitation as opposed to a straight up restoration. So the standards do allow you to make additions and to make changes and to replace deteriorated materials that can't be saved, and they have guidelines for that. But these standards might differ a little bit than, say, your local historic preservation standards. If you are in a historic district and your city is a certified local government that has a historic preservation commission, their standards might be stricter or looser than these Secretary of the Interior standards. Meeting the local standards for your property doesn't guarantee that you'll also meet the Secretary of the Interior standards. So you want to make sure that your project does meet those when you are designing it. Some legal text for your lunch hour, get you all jazzed up for the afternoon here. This is how we actually officially define qualified rehab expenditures. QREs are what the tax credit is based on. Again, remember, it's a percentage of what you spend. These QREs are considered what you spend, the official definition. So for commercial, on the state level, we crib directly from the federal government and the Treasury Code, Internal Revenue Code. This is where that lives, Section 47C2A. We're going to have a bigger breakout list coming in a second, so no need to rush onto Google and Google that just yet. Residential is actually defined in the text of the law that created the Colorado Historic Preservation Credit, so it's actually laid out in detail within the text of the law. Here's kind of a broad definition of it: exterior and interior improvements. Generally, your qualified rehab expenditures are going to be anything where it's materials and labor that you're spending on a project. So if you are buying lumber, or you are hiring a contractor to do work, or you are hiring the contractor and then the contractor goes out and buys lumber and charges you for it, you are spending money on a rehab, and those are the things that would qualify for it. So just as a broad term, that's typically what would be considered a rehabilitation expenditure. But in detail, here's a little better list for that of what's allowed and not allowed. And actually, again, materials and labor pretty much across the board. I want to focus on what's not allowable because that's a shorter list. And this is pretty broad as well. So acquisition cost, the cost of actually buying the building would not qualify. Cost of adding additions, this is written into both the federal and the state law. So you are allowed to add on to your building pretty much in any direction, sideways, up, digging out a basement from a crawl space to a full basement. All those are considered to be expansions of the property. None of that work is qualified as a rehabilitation expenditure. But again, that doesn't mean that you can't do it. It's just that the cost associated with it wouldn't qualify for this credit. Same applies for other things like landscaping, site work, what they call hardscaping, so pavement and parking lots and things. Any personal property that you have. Personal property is typically defined as anything if you would sell the property, if you could take that thing and put it into your moving van without having to rip apart half the building to get it free, you're probably going to consider it a personal item versus part of the physical property. Any kind of legal fees that you might, permit fees, things that you might have to spend in order to jump through the hoops at the local government level, those are also not considered qualified expenditures. One thing that is not on this list that does qualify is the cost of hiring an architect or an engineer to do studies or to prepare plans. Those are also considered to be qualified costs. Even though those are soft costs, they're not materials, they're not labor, that's something that you can include in the list. We always recommend that you get an accountant or some kind of tax attorney, somebody with familiarity with Treasury Code, to really go through your list and make sure that you are maximizing your credit. Unfortunately, no one on our staff, and generally at the local government level, no one at their staff is a certified public accountant. They're not going to be able to do that kind of in-depth research that a real CPA could do. So we always encourage people to hire someone like that if they really want to squeeze every last drop out of this credit. So the federal tax credit, just in a kind of a nutshell, you do have to be listed on or be eligible for the National Register. If you're only eligible for the register, the Park Service expects that you will get your property listed on the National Register eventually. So that is a requirement of that federal program. The tax credit is 20% of the money that you spend. It's a flat 20% on those qualified rehab expenditures. There's no cap for it, which is pretty great if you are the owner of a very big project and you want to do a very big thing. Denver's Union Station was a $40.5 million project, so they got $8 million in federal historic tax credits for that. Again, No project cap. It's straight 20%. Whether that is a small amount of money or a very large amount of money, you are going to get that 20%. And it lasts for up to 20 years. So you can carry that tax credit forward for up to 20 years. The only difference they've made recently is that when they revised the tax code a couple of years ago, they changed the law to say that you could only use a maximum of 20% of what you have in hand as a tax credit for the first 5 years. So to use that Union Station example, when they applied for the tax credit, it was 2014. They were able to get that $8.1 million in historic tax credits. And at the time, they were able to apply all $8.1 million of that tax credit to their first tax return that came across their desk. Today, they would have to split that into 5. So divide that 8.1 million by 5, and they would only be able to use that 20% of that each year. That was a cost savings measure that was built into the program to lessen the general impact in any given tax year. That good news is that compromise allowed that federal tax credit to stay on the books, because originally when they were looking at tax credits, when they were looking at budget cuts, that was one of the tax credits that took away permanently and were originally going to cancel. So this was the compromise that allowed that to stay. Gonna jump into the state one. I think a lot of folks will find the state one a little more friendly. Starting with the fact that you can be a local historic landmark. So you can be a local historic landmark, not listed on the National Register at all, and still be able to take advantage of this program. There's also a state register of historic properties, or you could be listed on the National Register in order to claim this credit. So a much broader segment of historic properties do fall under this. You can be the property owner, you could be a tenant. If you are a tenant, you have to have an active, in a big city like Denver, a 39-year lease. In a rural community, which is most of the state, it would be only a 5-year lease, because it's very hard to get a 39-year lease in most rural communities. So that is now, the requirement is you just have to have a 5-year lease. And as a leaseholder, you can actually do the renovation work yourself and take that tax credit as if you were the actual owner of the property. Credit is anywhere from, actually now, anywhere from 20 to up to 35%, depending on conditions. But this is the baseline credit. So if you're spending $2 million or under, you get 25% of that back as a credit. Once you go over $2 million, that tax credit drops to 20. So it's kind of like an income tax, where the first portion of your income is subject to X%, and then once you go over that, the next chunk of income is subject to a higher one. This is sort of the same thing, where you are getting a credit based on where you are and the amount of money that you're spending. There is a project cap that is $1 million. So if you go over a certain amount, you are not going to actually get any more tax credits beyond that. It's limited to $1 million per property owner per year. And that includes, even if there are bonuses, if you're in a disaster area that's been declared a disaster within the last 5 years. I've got some news on that I'll add at the end of this. Or a 10% credit if you're located in a rural area. So you can bump it up, but does not allow you, even with bonuses, does not allow you to bump up beyond that $1 million cap, that hard cap. States set aside $10 million a year. One good news is, even in this crazy madness and budget cuts right now, that $10 million is guaranteed to us out to the end of 2029. And that's split into $5 million set aside for big projects where they are spending more than $2 million. And $5 million goes into a special pool for small projects where the cost is under $2 million. And that's to allow smaller communities and smaller projects to be able to have access to credits without having 1 or 2 or 3 big city projects come and scoop up all of that money at once. So we try to spread it out between big businesses and small businesses, large complex projects, and smaller simple projects. You can carry this project, carry that credit forward for up to 10 years. And the great thing about this credit that you can't do with the federal one is that you can sell it. You can transfer it, you can sell it to anybody in the world. And it's a matter of just letting the Department of Economic Development know that you want to do it, and they say, okay, and then it's done. So this is a great, no hoops to jump through, no fees to pay, no complex filing, no complex ownership structures. It's just, if you want to give me your tax credit, you just say, I want to give Joe my tax credit, and then I get a tax credit. Don't give me your tax credit. I probably don't need it, but this is a way for you to monetize that credit. So if you are, for example, a nonprofit, you can still apply for it and get this tax credit. And then you're a nonprofit, you don't pay any taxes. You can still monetize this credit by selling it to somebody else who does pay taxes. They give you, say, 85 cents on the dollar. So if it's $100,000 in tax credits, they gave you $85,000 in cash, and then they save $100,000 on their taxes over the next 10 years. It's a win-win situation for everybody around. We're really happy about that. There really aren't that many tax credits that you can do this with, that you can sell and transfer this easily, and it's probably the crown jewel of our program. There's also residential, and again, the feds don't allow you to do residential. A lot of states don't allow you to do residential, so we're really proud of this aspect of our program as well. Same rules apply about eligibility. The credit structure is basically the same. You can even lease a house. If you're renting a house and you have a 5-term lease agreement, you can still take this credit as well. The project cap is only $50,000. That's the only thing that has stayed the same. And honestly, that's $50,000 in 1990 money. That number has not changed since the first tax credit law was created back in 1990. So it doesn't carry the same weight that it used to, but it's still $50,000 for residential, and it resets after 10 years. So if you did a tax credit more than 10 years ago, you can reapply and get another $50,000, put that towards your state income taxes. So also, if you sell it, then the new owner wants to do some rehab work, they're not tied down by the fact that you did a rehab project 5 or 10 years ago. They're no longer allowed to claim credits. Once you change ownership and sell it to a new owner, they can start doing all the rehab work that they want, and they have a clear and free to get up to $50,000 themselves as well. There's also no holding requirement, so if you do get a tax credit and circumstances require you to then sell your house, let's say you get transferred to a different part of the country, you're not going to take a hit, and the person buying your property is not going to be penalized either. So that's a nice thing, a nice change that we've made to the law. Some other changes that we made that are coming online now, the biggest one is the rural category. So we wanted to increase participation and economic incentives in rural areas. So if you are in a rural community, this is generally cities that are under 50,000, or counties that are under a certain population, cities that are under a certain population. Generally, that is almost all of the state. There is a list that we maintain online at historycolorado.org that specifically defines what is a county or a city that is an urban area and what is a rural area. But generally, anything outside of the Denver metro area is considered to be rural, with a few exceptions here and there. Larger areas around the state, as you might imagine, Grand Junction, Greeley, some of the larger counties in the state are considered urban, but most of the state is going to be considered rural. And for those folks, not only do they have that shorter leasehold for commercial properties at only 5 years, but they also get a 10% bonus that can bump up their tax credit up to 35% for a rural commercial property, and an automatic 35% for a rural residential property. So that's going to be a huge boost for them. Also, the minimum expenditure for commercial credits drops to only $20,000 for commercial. It's only $5,000 for residential. So it really lowers that threshold in the amount of product costs that you have to amass. We also anticipate that's going to help a lot for rural communities. Sometimes you just want to do a really simple project. You just want to replace a roof. You just need to do some basic repairs to a property to stop decay, to stop something that is causing damage, to make some basic steps towards getting that property back into shape. And this would allow you to do that without having to undertake this huge, massive, complete overhaul of your property. You can do it bit by bit, step by step, and take that tax credit every single year. You can apply every single year. Again, the cap for commercial is $1 million per property per year, and the cap for residential is $50,000. So you can slowly build up to those caps as you go along. There is a review process. The state does a review in-house. The residential is still done on a lot of cases by local governments, and some of you guys may be doing that already. Reviewed by the local Historic Landmark Preservation Commission, if there is one, and they are a certified local government. They have the authority to do that. If they don't, or if you're not in a community that is a certified local government, then our office is the default reviewer. And it's a two-part application. Part one, just very straightforward. Part one describes what you're going to do, and part two talks about what you did. So you do part one before you start or while you're in the middle of a project. Hey, this is what I'm going to do or what I'm doing right now. And then once you're done with it, you tally up all of the costs and you say, this is how that project turned out and this is how much it costs. And we base that task credit based on that part two. The federal is a little more complicated in that they first want to certify that the building is either listed on the National Register or it's eligible for listing on the register. So that's the first step in their process before they'll even look at your work plan. Then after that, part two and part three roughly conform to our part one and part two. You're telling them what you're planning on doing, and then when it's all done, you say, here's how it turned out. Again, you're going to document that both through written form, by photographs, and if you need to, also have some plans, floor plans or elevation drawings, things like that. Anything that helps to describe in detail what the work that you're doing. Keep in mind that for this review process, the reviewer, especially if it's on the federal level, they're not going to be familiar with your location. They're not going to be familiar with the building other than the photographs and the descriptions that you send to them. So it's important to make sure that you you kind of place them in the room since they're not physically there to come out and look at the property. A work plan is really helpful for this. So you're going to have a step-by-step description of what you're doing. A lot of people will split it into work items like windows, plumbing, floors. Some people will do level by level. Okay, on the ground floor, I'm going to do this. On the first floor, I'm going to do this. On the second floor, I'm going to do this. There's really no right or wrong way to do it. Just the important thing is that it's organized and it's comprehensive. You really want to focus on what you're going to do and why you're going to do it, and then talk about how you're going to do it, the methods, the materials, the techniques that you're going to do to rectify the problems that you've identified. This is a work plan that we use a lot. This is actually an actual work plan. I like this one so much that I emailed the guy who sent it in and I said, can I please use this as an example for the state, for everybody? He said, yep. So this is a really great example of what to do in a work plan. See here, he's defined the architectural feature kind of broadly, just masonry. But then he's also talking about what's wrong with it. So in that described feature and condition, he's really focusing on here are the problems that have happened over time. There's some separation, there's things that are causing problems. And then below that, he's talking about how he's going to actually rectify that problem, the techniques that he's going to do, what he needs to remove, what he needs to add, what he needs to change, and how that's going to happen. So that is straightforward, a way to describe exactly how you're going to do it. And it gives the reviewer an idea of how your work plan is going to physically affect the structure, which allows them to use those standards for rehabilitation to determine whether this is an appropriate treatment for the problems that you've described. Also, photos are very handy. The Park Service actually requires clear color, at least 4x6 in size. We really like to see those as well. One nice thing about the 21st century is that it's a lot easier to take a ton of digital photos than to take a ton of print photos. You can submit digital photos. We would prefer that you print them out versus sending them on a CD or a DVD, just because recording requirements are going to change in the future, but physical paper copies are never going to change. It's handy just to have that in front of the reviewer versus trying to load up a CD or a DVD and click through them. Again, they can be digital or traditional photo prints. You really want to be comprehensive, have at least a couple of photos that show the entire building. Again, to place the reviewer in the room so they can be at your job site virtually looking at your building. But then details of areas that are damaged, details of areas that need work, details of areas that you are going to add additions to or make changes to, so that they can really see the details that are currently in the room, or conversely, they can see that there are no historic materials or there are no historic details in the area that you're going to work on. You really want to emphasize that. And the more photos, the better. There's really no such thing as too many photos, just because you can always skim photos you don't want to look at, but you can't do anything about photos where you would really like to look at something and you don't have them. Plans and drawings are the last aspect of this. It is helpful sometimes, especially if you have a complicated project or if you're making significant changes to the interior, you're moving walls, you're adding or changing windows, you're adding new additions to the property. Plans and drawings are a great way to actually describe that and show that to the reviewer. So these are the kind of things that you would typically include. People will shrink them down. This is more for, I think, my benefit than for anybody else's. The older I get, the less I like a tiny print. So generally you can shrink them down as long as they're still legible. But if they get too tiny, you might want to consider putting in a 11 by 17 or something like that. Again, scan stuff can be helpful for the state credit. You are allowed to scan things, so feel free to add those. Don't feel the need to add a full set of construction drawings unless you really think that that's going to help. Construction drawings are going to carry a lot of things that maybe won't be of interest to the reviewer: plumbing, electrical, mechanical, unless those things are actually going to physically affect the building. Example of that is that if you had a building with no heating and air conditioning, which you'll still definitely find around Colorado, and you want to add in, say, a forced air conditioning system with ductwork and everything, you'll probably want to show those mechanical plans just to show where that ductwork is going to go. But don't feel the need to send a 235 sheet set of construction drawings just for the sake of doing so. Got a chat here, so I'm going to try to stop in the share here to take a chat. There's a chat question, I think.
It's just me, Joe.
Oh, it's just Erica. Hi, Erica. So Erica is back. Erica has internet again.
Yeah,
that is very good news.
Link to our website.
All right, let's jump back in from the current slide. We're actually at the end of it, so it's actually good timing. Erica, you came in at the end of the movie. So that's actually what we had for the basic. Again, tax credit basics, just to kind of explain what these are and how these work. Here is where we live. If you want to reach out for more information. Also, we have our website, historycolorado.org, has a ton of links to what you can download, including application forms, links to the federal application forms, and links to the Secretary of the Interior standards for rehabilitation. I always like to say, if there's one thing the National Park Service loves to do more than anything else in the world, it's create new explanations and books based around the 10 standards for rehabilitation and how those apply. They also have a couple of cool online publications, including preservation briefs and preservation tech notes. And those deal with how people might approach specific knotty problems, like how do I deal with restoring windows? How do I deal with adding fire protection? These are case studies that show how other people went and did those projects successfully and met the standards, or in some cases, how they didn't meet the standards. Let's get rid of that and go back to Zoom world. So let's see if we have, oh, Erica, thank you, putting up the link there at the bottom of your screen. I think this is a good time to take questions. If anyone has any questions, you can either just chat in. You have to remember to unmute yourselves, but chat in, and if you have any questions, or add a couple of you guys here. Or in the chat box below, just to give you, or if you wanted to have a more in-depth discussion of certain aspects of the credit, we still got 30 minutes left in this, so by all means jump in and let us know. Or if you are a local reviewer and you have questions that you're wrestling with, we're also here to help with that.
If I had a residential property that it's not designated necessarily, but I think it would be eligible, and I decided to do the tax credits on some work that I'm doing currently. Could you do the work and then apply for the tax credits afterwards, or do you have to do those tax credits before you do the work?
That is a great question. You can actually apply for this credit without having historic designation. And And that's important because some municipalities, and also the state for that matter, are really wary about designating a property as a historic landmark when it's about to undergo a big rehabilitation project, because there's no guarantee that that rehabilitation project won't result in changes that would then make the building not eligible for whatever local, state, or national register that they were hoping to be on. So they don't want to be in a spot where they list it and then have to immediately turn around and unlist it. So a lot of times they'll say, hey, we're not going to designate you until you're done and we can see what you did, and then evaluate the building as it stands at that point in time. So to reflect that reality on the ground, we allow, and the feds allow you to apply for the tax credit just on the basis of being eligible for listing at the current time, with the expectation that you would then, before you would be able to actually pick up and use that tax credit, that you would go to the local entity or the state or the feds and get your property officially designated as a historic structure.
Okay.
So in that case, if you had a building that didn't have any historic designation yet, you would actually do the tax credit process first, do the reviews, do the work, get it certified for tax credits, and then go to the local or the state and say, I'd like to be listed I'd like to get historic designation now so that I can actually claim that credit.
Got it. Thank you.
Joe, this is Cynthia Neeb. I have a follow-up question to that. So if you have a building that's basically still retained a lot of its historic features on the exterior, the interior has been murdered. I mean, well, you can still it still reads as a church, but it's the Presbyterian Church in La Junta. Yeah, but the floor has been lowered on the main floor. They've stolen a lot of over the years. They stole a lot of the stained glass windows. The chandelier's been changed out. Yeah, but there's been some major changes. But here's my point. You would be willing, if we did apply for tax credits before it became designated, and it made sure that it was eligible for designation, but to go over some of our laundry list of the things that we would like to do to make sure that it basically meets, I know you can't guarantee, but basically meets the standards of what you would consider are eligible for the tax credits. I know you can't bless it because you can't tell what it's going to be until the work's done. And there are many, as we know, many different reasons why that may not be what you plan to do. So is that something that you would do, is maybe look over the basic plans of what's happening? Larry Lucas from Main Street's working on it with us. Yep. So
we do a lot of preliminary stuff, like part of my job, part of our, just in terms of History Colorado. It's very advantageous to us to come and actually to walk people through a project early on in the planning stages, because that is when everybody involved has the opportunity to make changes for the better, to give that property a better chance of meeting the Secretary of the Interior standards, a better chance of getting historically designated. So we do like to intervene early. It's a lot more profitable for everybody than to try to do it all at the last second once all the work's been done. So yeah,
right.
we do a lot of walkthroughs pre-application. We really can't do any physical walkthroughs probably this year because of everything that's going on, but we can still do virtual. I mean, the benefit of having computers and having the ability to look at things virtually is really a huge leg up for us in terms of looking at photos. Having these sorts of in-person, face-to-face meetings over the internet allows us to do a lot more work. So yeah, we would be happy to sit down with a building owner and walk them through the project and let them know the kind of stuff that they can and can't do, or at least should and shouldn't do with regards to a project, what is and what's not a historic character defining feature, and how they might approach a rehab project.
Well, the city bought it. Just so you know, the city of La Junta owns it. And we have chosen it. We don't want to do anything that would destroy the historic character of the building. That's already been 100% agreed to. So that that's a good thing. But I want to make sure that everybody understands what that might be. And as you know, if you're in a town, they don't listen to anything that you say. If it's somebody from 50 miles away, you're a genius. So that's one of the reasons why I'd like to call upon you to maybe back up some of the things that we might be talking about. And you might have some different views, and that's okay too. I just would like to know beforehand. So
Okay.
Thank you very much, Joe.
And while we're on the subject, well, we're not really on the subject, but I'm going to make up a subject based on something you said. Cities can own historic properties, but cities and towns and counties and other government agencies typically cannot apply for or receive tax credits themselves. So you wouldn't be in a situation where a city could buy a building and rehabilitate it and then sell that tax credit to someone else in exchange for cash. The law limits the ability of people to claim the credit to either private businesses, private owners, or a nonprofit that falls under the ginormous 501c umbrella. So not just 501c3, which is the most common one, but the 501c umbrella as a whole. There's, gosh, probably, I think they run through the whole alphabet of nonprofits there, but basically any kind of a nonprofit can claim it. A private company, a corporation, an LLC, a limited partnership, all these different organizations and structures can be able to claim this credit, but municipal governments, county governments, other government agencies, unfortunately cannot. So just keep that in mind. That's where that lease thing comes in, that it's often profitable for a local government that owns a property to lease that out using that 5-year rural lease to a for-profit or a nonprofit, and that agency would then be able to claim the credit for itself. So just something to think about there.
Good to know. Thank you.
There's a question. Cindy had a question about things that have changed in the last 6 months of the program. So far, so good. I think a lot of projects are still coming online in spite of all the chaos that's going on. We haven't seen any changes right now in funding. So we'll let you know if that happens. So far, not. The biggest thing that has changed in the last 6 months is that the rural provisions of the tax credit law that were signed into law in 2018 are now officially part of the law. So again, you only now have to spend $20,000 on a commercial project to qualify for that credit to meet that cost threshold. You are getting 35% for a rural residential property. You're getting up to 35% for a rural commercial property. You are being able to apply for those credits with a smaller lease. So those are the biggest changes that have taken place over the last 6 months. But otherwise, program is the same. It is still authorized out through the end of 2029 with level funding, $10 million per year. And we'll play it by ear and see how that goes. Got everything else, I think. Eric has already promised Jim a data dump, so look for that to come. Are there any other questions, or are folks running into any other issues that they might be concerned about with the administration of their programs or in applying for programs?
Hi, Joe. I have a question. Thank you so much. This has been really informative. My name is Travis Wright. I'm on the Gilpin County HPC, but live in Grand County. I've spoken with and have been working with Erica on hoping to restart historic preservation in Grand County, as they no longer have a historic preservation commission. They're no longer a CLG. But my question is, my wife and I live in the first hotel in Fraser, that's 56 years old. It needs a lot of work done in the future years, new siding, new decks, new roof. And the building basically looks like how it did in the 1960s, except for that new wood has been painted a Forest Service green color over the years. But is there eligibility for any state tax credits in a scenario like this?
So if you're in a community that does not have local landmark designation, and it does have to be a certified local government, there are a few areas in the state, Jefferson County is one that comes to mind immediately, where they have a historic preservation commission and they have the ability and do go out and designate properties as local historic landmarks, but they're not a certified local government. Law requires them to be that certified local government designation to be able to designate a property as historic and make that property then eligible for those state tax credits. If you're not in a community that can do that, then you have to be either listed on or eligible for the National Register of Historic Places or the State Register of Historic Properties. And of course, you can be in a historic district where your property contributes to that historic district on either the national or the local level. So you don't have to be individually listed. For example, if you were in Central City, there's a historic district, so you wouldn't have to be individually listed. You would just have to contribute to the district. If there is no current historic designation, then again, you can still apply for those credits, but you wouldn't be able to actually start using them until you got that historic designation.
Ah, okay. Thank you so much.
And Travis, if you wanted to, I can send you the eligibility form for the state and national register. So if you want to have the building reviewed ahead of time, just to get an idea, I would recommend doing that sooner rather than later, just so you know ahead of time.
Okay. Yeah, perfect. Thank you so much, Erica.
You're welcome. I'll send it to you over. I'll send it over to you now.
Perfect. Thanks.
Our staff is very good at pointing people in the right direction. So they will take a quick look at your property, how it looks right now and its history, and they can give you sort of a gut check on what direction you might want to go and what level of historic designation you might be able to achieve. For example, whether they feel like it meets the criteria for the National Register or just the criteria for the State Register, which is a little broader, or that perhaps going for a local designation might be your best bet if that's an option for you. So it's almost like a grain bin where they're directing the grain to the appropriate bin based on what's coming in. And that gives you a leg up on being able to plan your project. The last thing you want to do is to assume that you're going to get listed on the National Register and go through the whole rigmarole of tax credits and reviews and then find out at the end that you're not eligible for the register. So that is an important first step for anybody if they don't currently have historic designation.
Awesome. Thank you.
Also, Jim is in my brain right now because having a contact at OEdit or Revenue, we do have a contact at OEdit. We do not have a contact at Revenue, which is sad. We would really like to have one, but they've explained to us that they just simply do not have anybody who is experienced enough or confident enough in historic preservation issues to really confidently state things like you can do this or you can't do this or this is allowed or it's not allowed. So they've kind of deferred all of their stuff back to our office, and for commercial projects to the Department of Economic Development and International Trade, which is our partner in administering the commercial tax credit program. What we do, you can go to their website. It's choosecolorado.com. And they do have contact information for folks and the ability to reach out and ask questions either from yourself or from a CPA or from anybody else who would like more information about the program. So they do have that ability to reach out to them as well. They are a good source for answering questions about ownership, about leases, about qualifying costs, meeting cost thresholds, and certifying your expenditure sheets if that's something that's required. They can give you the details on that. Their focus is definitely on the money side, and our focus has always been on the meeting those Secretary of the Interior standards and protecting the historic building side. It's a kind of a joint effort there. But yeah, that is a resource that you can also reach out to if you have questions about especially the numbers side of the commercial historic tax credit program.
Well, thank you, Joe.
And Joe, kind of on that same line, would someone from OEdit be willing to say what is a QRE and what isn't?
They actually have. They are currently working on a more definitive list that they're hoping to post. They're currently revising their website and their program manual, and they're hoping to have that online soon, where they would actually, you'd open their program manual, we post it on the website, right, with the rest of the tax credit stuff, and you could open that and flip through, and they would have a more detailed layout of what would generally be considered a qualifying cost and what would generally be considered a non-qualifying cost, and the reasons why that would be. So they're currently developing that in the form of an Excel spreadsheet that they're going to attach to that document, just so you can kind of run through broad categories and get a question. I don't think that they would be able to have the expertise to go line by line through it. For example, is do light switches count? Do flooring, does flooring have certain particular type of flooring count compared to this other specific particular type of flooring? They probably wouldn't be able to go into that much kind of detail, but they can at least give you some definitely narrower than the broad categories that I gave in this presentation. They'd be able to narrow it down more and have that in writing so that you can look that up and check it. That's what they're working on right now.
And I guess my reason for pointing that out, Joe, is that technically it's going to be up to their CPA to decide, well, and the Department of Revenue, what is a qualified cost,
right?
Correct?
So ultimately what you're doing, whenever you're applying for a tax credit, when you sign that page, you are certifying that the costs that you are claiming are, to the best of your knowledge, accurate, and that the tax credit that you're hoping to get is exactly how much of a tax credit that you ought to be getting. And that's what you're certifying there. Typically, for the commercial tax credit, a requirement of the law in order to provide oversight is to have a third-party CPA look over your cost sheets. It's not your general standard accountant, but somebody else that you hire specifically to come look at this particular project, go over your particular books, and make sure that they meet the requirements of the program. So, but that CPA is then also signing off to the best of their knowledge that what you're claiming is qualified for this tax credit and that you ought to get the credit that you're asking for. So they are also certifying with their own, their professional opinion that this is okay. Typically that is enough for OEdit. Their staff might go over and look through it to identify any errors that might stand out to them, egregious errors. And we have seen some in the past. One of the very first ones that we got that was certified by a CPA, a third-party CPA, the very first line item in the cost list was the acquisition cost of buying the building, which is very straightforwardly prohibited as a qualified cost. So they are good at catching the bigger mistakes. They probably wouldn't be able to, at the Office of Economic Development, they probably wouldn't be able to catch the tiny ones. So it's important to get a good CPA to make sure that you are maximizing your credit. The good news is that the credits, qualified costs for commercial, are based on the federal, and the federal definition is not limited just to tax credits. It is the federal definition of what they consider real property versus personal property. And so it is broadly defined, but in a way that other programs, other tax credit programs, and other federal programs just in general rely on that same part of the tax code to define their own programs and their own qualified costs. So most CPAs and accountants ought to be familiar with that chunk of the tax code because they've probably looked at it before for other kinds of economic incentive programs.
So moral of the story is to have a good CPA.
Always a good thing to have. You can get one of those Hollywood CPAs where suddenly you are now entitled to a $300 million tax credit after you spent $30,000. They work their magic.
But then you'd still have to come up with that much tax liability.
This is true. Well, they could probably arrange for that too.
Oh, okay.
One thing to point out, and this is just off the top of my head, but one nice thing about this tax credit is that it does stack and play nicely with other credits and other grants and other things. So if you are getting a grant or a tax credit or some kind of financial incentive from another area, another institution, it doesn't affect your ability to claim this credit. And if the bulk of your funding for your project is not coming out of your own pocket, let's say you get a grant from the State Historical Fund to do work, and that is, say, 75% of the money that you're spending on this project is because somebody is giving you money from a grant or a loan or something, you can still claim that money just as if you would spend it out of your own pocket. So the tax credit is based on what you spend. It's just in terms of what you're actually physically spending, not necessarily on what is actually coming out of your own personal pocket. So your grant, your tax credit isn't going to be limited by the fact that you get a grant from another federal or state agency, and it's not going to be something where you're prohibited from claiming the state historic preservation tax credit because you're claiming a different kind of tax credit from a different federal or state agency. So there is a lot of flexibility there that you don't often see in other programs. Erica's got another link for you guys in the chat window. So links to designating a property. We do have a list of certified local governments. We also have a list of what certified local governments currently review residential historic preservation tax credits and which ones have chosen not to. That's a choice that each CLG gets to make. So you might have a situation where you are in a certified local government, but that local government is not reviewing tax credits. And then again, the state is the default for that as well. So it would come to us as well. And we have a currently up-to-date list of both where you are, where CLG is,